which is like a really bad recession.
You see that being
more
of a real thing now?
Because usually with recessions, it starts inflation goes down because people are spending less. Mm-hmm. But in this case, inflation hasn't gone down. I feel like recessions start and GDP's starting to.
Hey guys, welcome to Generation H! Today's episode, we're going to be covering some articles that we found. We're going to link them in the bio underneath. But if you don't know and you're not part of the team, make sure you subscribe and
hit that like button for the YouTube algorithm.
All right, so today we're going to do something slightly different than what we usually do. We have a couple articles pulled up. We're going to read through them and start talking through the bullet points because a lot has changed, not just since the beginning of the year, but over the last 24 hours, 48 hours. Today is June 16th, and we just received a 0.75% rate hike from the Fed. So what's that doing? How's that affecting us? If you haven't watched any of our previous videos, you'll see how much of a difference that makes. But we're going to recover that or cover that again in some of these articles that we read, and then we're just going to kind of have an open conversation about it and what our thoughts are. So this first article is from Forbes. It's mortgages surge past 6% and hits their highest level since 2008, and the housing market could torpedo the U.S. economy, experts warn. And this article was on June 15th. So the top line, before we get into the key points, is mortgage rates have surged higher this week as markets digest more aggressive interest rate hikes from the Federal Reserve, and with the average 30-year fixed mortgage rates hitting the highest level since 2008. Experts warn that the warning signs of the housing market could spell trouble for the broader economy. So we can get into bullet points, or if you guys have any thoughts already.
Well, I can tell you that a lot of new investors have called me and they're nervous and they're scared. So I'm glad we're covering this because this is just going to go through what to do when you're scared in a crazy up and down economy.
They're scared. Scared in what way? Scared to buy?
They're scared of everything. I mean, they're scared that. So I got a couple investors that I'm helping them flip their house, and they're like, "Dude, we need to get this thing done in 2 weeks because who knows when the next Fed is going to raise it, and who knows what our buyers are going to look like." And I do think you need to think about it because the buyers for that $400,000 house today is not going to be the same as it was 2 days ago, essentially.
Yeah. I think that comes from a place of not having enough information and not being not knowing how to resolve the problem. Because I mean, I think it was today or yesterday I put a funny TikTok up of every problem has a solution, right? Yes. So this is a problem, we have no control over it, but this is the industry that we work out of, real estate. So what are we going to do in order to combat that?
Yeah.
Right. So if you're a new time investor. First time you're doing a flip, second time you're doing a flip, first time you're doing a burr, second time you're doing a burr.
Yeah.
You haven't quite found your footing yet. So when something crazy comes around like this, who knows? Is your house even going to appraise anymore for what you thought it was going to? Or is the buyer pool going to be there like it was before? Is it shrinking? So there's a lot of new things that you have to consider. What's your new plan of attack in order to make sure you still sell this house?
Yeah, because you might not even cash flow anymore if you're planning on refinancing it.
No kidding.
Especially if the rates go from, with the investor
5.5
rates are probably
to 6.5.
Yeah, the investor rates are probably between 7 and 8 right now. Who knows? If the average 30-year is 6.2, investors are probably getting between 7 and 8 right now.
Yep.
Obviously, that's baking in the next future Fed rate hikes. Now, if inflation comes in again high next year or higher than expectation, or not next year, next month, higher than expectations, they're going to raise them, even jack them up all of a sudden, right, like that
even
again.
More.
Yeah.
And then banks are going to compensate for that. Now, if inflation stays on their guide, what they think it is, around 8% or decline from the 8%, interest rates probably won't change much.
I was going to say it might stay the same or trickle or
because they've already baked in.
May even go down 0.1 or 0.2
Yeah.
just to keep us interested and keep us coming back.
Yeah, and that's going to be a really interesting time to see because obviously there's a lot of loan products out there, right?
Yes.
So now that the buyer pool is shrinking, the lenders that go after investors and the lenders that go after just regular traditional home buyers is going to become a lot more aggressive.
Yeah.
Right?
And their
So
margins are going to be tighter too because they're going to be giving people better deals. They're going to want to get more business even if they're only making like $2,000 off someone.
That's the thing. It's not only scaring us, but I guarantee you it's scaring a lot of lenders out there because they don't have any control over this. And not only is it, and it's probably hurting them on a different level because at least we can all make up for it and flip the house or something like that.
Yeah.
They have no control.
They have one exit.
They have one exit, and that's it. If you don't buy, they don't make money. They don't loan loans.
Yeah.
I mean, my mortgage broker, he called me. He's worried because his refis completely stopped. His new home buys have gone down about 40-50%.
Yeah. And they're I think refinance are at a 22-year low, if I'm not mistaken.
It is.
Something crazy like that. Obviously, everyone got their refis out in the last 2 years, so it kind of makes sense why refis are
Anybody that could refi, I hope you did because you missed out if you didn't.
But then that means there's some layoffs going to be coming in that industry. I have a friend that works for a title company, and they just had a meeting today saying we're not getting as much business and just preparing them for layoffs if they don't keep getting business.
No kidding. So even the title companies are. So it's just trickling down the line.
It's trickling down.
It affects so many different industries. Real estate agents are probably having a hard time too.
Insurance agents. I mean,
everything.
it's just going to trickle down from there. Once the insurance agents drop out, then it's I mean, title companies, the whole chain is coming down.
Because one real estate transaction feeds 15 people.
Oh yeah, because I used to be in B&I group, and that's how it worked, dude. The mortgage or the realtor would get a client, pass to the mortgage broker, to the insurance person, to the title company, and then to me as a security guy when I was doing security systems. It would just trickle right down the line.
And then inspectors and appraisers, if they're not getting enough business, they're going to have to get laid off too and stuff like that. So.
And we by no means are saying don't buy because rates are out. It just be more conscious about what you're buying.
Oh right?
Because I think we're all still buying. I think you might be the only one that's not like.
I'm still buying, just a little more conservative. Oh yeah.
You're not like in escrow, gonna close in the coming weeks, or just closed a couple weeks. But you're still obviously looking for opportunities, and that's exactly what I'm saying. Is like still be out there looking to buy, but just make sure that you're protecting yourself. You're hedging against the possible another 0.75% increase or whatever that could come, right?
And with these rate changes and all that, we've all changed our strategies because you have 3 houses that you're working on, and instead you would have normally kept 1 or 2 of them. Yeah. Now you're going to sell them.
Yeah, I think I would have definitely kept 2 of the 3, and now I'm strongly considering on selling all 3, maybe keeping 1 depending on how the other 2 perform. So just opening myself to more options.
And then I'm on the opposite side of that because normally I would sell, but now my buyer pool has diminished, so now I'm just going to keep instead and take the cash flow instead.
Yeah, and your strategy might change depending on if the market goes down. You might want to keep all 3 years.
Yeah,
it could.
In 2 months when you're done, you could decide to keep.
Yeah, and for me, the reason that I'm looking to do that is I just want to liquidate at least the 3 that I have now and that I'm working on, just so I can be a little bit more cash heavy for the coming months, right? So like everybody has a different risk tolerance. Everybody bought at a different point, so different price points that they're buying, different neighborhoods that they're buying out of. So like all of that's going to affect whether you keep, buy, or whatever, right? So one of the key points that they made, so they listed a list of bullet points. One of them is the average interest rate on the popular 30-year fixed mortgage home loan now sits at 6.2%, its highest level since 2008's financial crisis, and up from around 5.5% a week ago.
That's
crazy.
That's
right.
Wild.
Because you dissect it, you look at a few videos back, we discuss how 1% decreases your buying power by about 10%.
Yeah.
Right? So in one fell swoop, one transaction, one announcement, you lost 10%.
Yeah.
And it just goes back to remember all of those people that talked that they were going to ride this wave out last year? Now they're getting stuck with this. I feel sorry for the people that waited because you had crazy good interest rates and you could have got a $500,000 house. Now you're sitting at 6.2%. You only qualify for a $350,000 house.
Yeah, that's true.
At the same mortgage rate. People don't understand that. They thought that the housing market was going so high. I'm not paying them crazy prices. But look at your crazy good interest rate made up for those crazy good prices, and now it's the opposite because those houses didn't go down in the last week.
But that's the thing; they could go down in the next few months to compensate for that difference.
You think it'll make up for it? it can't drop but so much to make up for a 1% interest rate.
I mean, if people can't afford it because it's just all people are losing or not getting paid as much or staying on par with their jobs or layoffs in general.
Do you think they're going to over leverage themselves and try to afford it anyways?
Oh, well, they can only get approved if the bank.
Yeah,
I mean, it's only
they're
with
going
the
to
bank
max out
changes.
their approval though. Now, because
I
now
think people
are,
do that anyways.
So people do that anyways.
And the bank is going to make adjustments, right? So like, your rate increased. Sorry, it didn't get locked in. I think that most banks are probably trying to avoid that if they can, just because they're going to be caught holding a bag. But if they don't lock in the rates, and you're just a traditional home buyer, they're just going to come back to you and be like, sorry, you can no longer afford this house because you were trying to get up to your 35-40% max, right? Yeah. Which is usually, well, you were riding it so close that you can't buy this house anymore. We're not going to close.
When you say max out approval, do you mean just like the lowest down payment you could possibly do? Or
No, max out approval, because you know how they give you a range. Like, you want to stay in the 350 range, but technically you're approved for 420,000. A lot of people are going to say, well, I wanted to stick at 350.
Got it.
Now we might have to go to 420 and be house poor because that's the house that they really need. Because a lot of these families, the reason they're getting that $450,000 house is because they need the square footage. They have 3 or 4 kids at home, and now people are working from home, so they need that extra office space, which requires a bigger house.
Yeah. I think we're going to go back to, and this is just a hunch, I think we're going to go back to smaller homes and people just appreciating what they have. So if people are just going to have less things, they're not going to be as flashy, their houses might not be as big because things are going to get so expensive. And people are just going to appreciate family and the little things that they have.
But someone has to get those bigger homes, right? Someone has to live in those.
Sure, but everything is going to come down. I think all home price, everything's going to come down.
So you think home prices are going to come down?
I think it's going to need to. I mean, with inflation, though, it's not really going to feel like it because everything is going to be more expensive, right? So, like, you're probably still going to be able to buy a $450,000 house, but everything else, gas is going to be... Don't take this politically or anything, but, like, gas could be $8 in 3 years. You know what I mean? And that's just going to suck. So, like, are you going to do road trips all the time, or are you going to go out and just kind of, like, drive around in circles?
You're going to deck out your house so you can stay there more.
And you're just going to stay
buy Tesla.
Oh, just like the other article. The other article we read, they're giving 20-year loans for pools. They want you to stay at home. They're giving you that second option. Hey, we'll give you a loan.
Which is not good for our economy, though.
Right?
Right? Because we're a global economy. No, we're global. So, like, if you're not out spending,
traveling,
their GDP's going down.
Oh, yeah.
Right? So then, like, we're in for it. We'll see. We'll see. All right, so the next bullet point is existing home sales and mortgage applications have both taken a hit aimed at rising interest rates and looming recession fears, as the median monthly payments on the new 30-year mortgage rates rose more than 50% since last year.
Wow. So that means that they're
Should I read this again?
50% more for their payment? No kidding.
Existing home sales and mortgage applications have both taken a hit aimed at rising interest rates and looming recession fears, as the median monthly payments on the new 30-year mortgage rose more than 50% since last year. So to your point from earlier, the people that were waiting now have to pay 50% more in their monthly mortgage payments because of everything. Because home prices are still the same or slightly lower, and your rates are, I mean, you were getting them at what, 3 to 1, 3 1/4, 3.5, and now their average is at 6.2. You're almost at double.
That's unbelievable.
You're almost at double, and that's why you're paying 50. Your monthly payment's 50% more.
So if you would have basically jumped on board with the crazy housing market last year, you'd be paying less money.
Probably. Yeah. Oh, definitely.
Even though you paid $50,000 over asking price and you thought that was crazy, now you're looking back and you're patting yourself on the back, thinking you made a good move.
Why? Because back then at 3%. Your pay down was towards principal. So you were building equity. Now your high payment is going towards interest
and
which you'll never see. Right? So like.
Now Dave Ramsey is going to be right. You need to start paying that extra monthly payment.
No, he's been talking about how now is the best time. I think that's where a lot of people
I saw the clip of
now is the best. I think it's because he is suggesting that we're going to be at 9%. Like we're going to like the interest rate is going to continue to go up.
Yeah.
So he's like,
no, but he doesn't condone borrowing money at all anyway. So when he says now's the best time to buy a house, he's talking to his audience, which are only cash buyers,
you're right. You're right. Yeah.
True. Very
true.
Because the majority of his audience is cash buyers.
So maybe most people can't.
Who can?
I know. I mean, it's the stupidest advice ever. But
let me save $100,000 a year. That's reality. Yeah.
Wow. So that's a big one. That's a heavy one.
That's huge.
Today's housing bubble is the Achilles heel that could put a torpedo. Or sorry. Today's housing bubble is the Achilles heel that could put a torpedo into the side of the U.S. economy, especially as metrics such as home builders' confidence in traffic of prospective buyers continue to plunge, predicts James Stacks, president of Investech Research. So, what do you guys think? Do you think that the U.S. economy...
It's a little bubble now? Is that basically what it's saying?
Yeah, so like the housing piece could have such an effect on the U.S. economy. We kind of talked about it, right? Like
that's what happened in 2008, right?
I think we're 100% going down that road because it has to affect the economy. If your mortgage payment is 50% higher, you already said your payment's 50% higher, your gas prices are higher, everything's higher, you're not going to travel.
You're not going to go out and spend money, right? You're not going to go out and put money into the economy. You're not going to go out and buy new shoes. You're not going to do frivolous spending,
which is going to completely derail things because we were on a huge uptick because COVID knocked everything down. No one was spending anything. They couldn't go anywhere.
Savings were at an all-time high.
Savings.
Yeah, everything.
And then 2021, they're like, we're free. Let's spend our money. And then now we're trying to dip back down because you can't spend any more money because I hope you saved a lot of money because now your gas prices are up here, your mortgage is up here.
Yeah.
I mean, how do you make up for it?
Yeah, so I mean, it just reminds me of like those articles that always come out that I don't know, I'm making these numbers up, but like 50% of people only have $1,000 in their savings.
Yeah.
Well, like I think of that and I'm like, okay, so how do you
live?
How do you even save enough to have $1,000? Whatever means those were.
Yes.
Those might be gone for those people
because of inflation.
Because of inflation.
Yeah. Oh yeah. Those people that were saving $2,000-$3,000 a year, they're probably saving nothing, a couple $100 a year now because they're eating it up in every other cost.
Yeah.
Yeah, seeing that the saving rates are the lowest since like the .com bubble in 2000.
Wow.
Savings people have the least amount in savings, or no, the rate, savings rate. Yeah, the amount they're saving per.
But then 2 years ago, it was the highest.
Yeah, it was. Yeah. Well, because no one was spending anything, so.
And they encouraged people to spend, so people were spending, and now
overspending.
So it's an overcorrection. It's been an overcorrection every single time.
Every time.
There's a pendulum. You just always need to kind of find yourself at seeing the extremes and just kind of always finding yourself in whatever that middle ground is.
But it goes back to what we've always preached: live within your means.
Yeah.
Don't overspend. If you can afford it, think about it 2 or 3 times if you need it. Because I know me, I live in my means. I don't care how much I made last year or how much I made the year before. I spent the same amount of money the last 5 years as I did 5 years before that.
Yeah.
And I try to keep within that little bubble because the second you go out of it, you get in trouble.
Mm-hmm. Yeah.
And y'all are the same way. Y'all lived in the same houses y'all lived in. You didn't jump on board and pay crazy just because the housing market was crazy, jump to a bigger house. And we all have growing families, but I've kind of stayed hesitant about buying a bigger house just because of all this.
Yeah. Mm-hmm. Yeah. No, it's. I agree. I have to agree with that sentiment that the housing situation could. It says today's housing bubble.
Mm-hmm. The housing situation could cause a downward spiral.
Yeah,
but it's not.
Could be the Achilles heel.
But the housing isn't what's the cause of it. It's really the inflation and the Fed that are
sure. But the Achilles heel is what I'm taking from that is like it could be the last straw.
Okay.
Right. Like there's a bunch of other factors. Yeah. It's not saying that the housing is the reason, but there's a lot of other factors. But the housing situation could be the last straw, the heel that like ends up
puts us down. Because you're talking about because like everything's already inflation's way up, stock market's way down already,
and then because everything is so tied to housing, it could be the thing that kind of like spins it out of control. New data on Wednesday from the National Association of Home Builders show that home builders' confidence declined for 6 months in a row, failing to its lowest level in 2 years as surging inflation and high mortgage rate prices buyers out of the market.
So I agree with that as well, because
I guess that's the same thing we've been talking about.
Yeah.
I mean, you got to think these houses that the new builders are building right now, they're going for as high as you can possibly go. Like in my neighborhood, they're building these houses starting at $475. My neighborhood was starting at $300 when I bought 5 years ago, and now it's gone up $175,000 for the same exact house.
Yeah,
but a lot of it's materials
costs,
and other
labor
things
costs, material costs,
have gone up because they have to go.
Holding
gas
costs have gone
prices
up.
are So
now,
I think it's scaring people though.
Now, something I kind of brought it up earlier about, I think it was something like 16%, 17% of home buyers that had a new house under contract, once it came down for final selections, for talking to the bank and just getting everything finalized, opted out.
See, that's crazy.
Of finalizing the sale.
Yeah, so those houses are going back on the market.
They're going right back on the market, and I mean that just kind of tanks everything, right?
That's risky for builders. Like if
It's
I was a
very
builder,
risky.
I would be scared right now.
That's very risky, but then I also start to think about what everybody talks about, which is like housing demand, right?
Or the shortage.
The shortage, yeah. So like, it's a double-edged sword. Like I get it.
Yeah.
So where are those people going to go? Are they going to rent?
No, I'll probably
No.
Well, the shortage. I feel like the misconception of demographics of people that there's so many millennials that need housing or whatever. I mean, yeah, that could be true, but if people's affordability go down where they're not making as much money, I mean, it doesn't matter how many people are looking for houses. Everyone's gonna pay less for houses.
Yeah.
So the argument that people like to pull up about the demographics and there's a shortage of supply. I mean, if the economy's bad and people are getting laid off, I mean that doesn't matter because people. Like, I don't know. You know what I mean?
Do you think people will be more resourceful and find other means of their living situation?
Well,
like
I'm
they
saying,
won't be out in the market to buy.
I'm saying if everyone's making like 20% less because of inflation, I mean, it doesn't matter how much supply's out there. The housing's going to drop 20% less because people are making 20% less.
Yeah, no. So I agree with that one, but I'm talking about just manufacturing, building new homes, whatever. Like, all that's going to come down then, right? Because if we're at an all-time low and we're at a deficit of 10 million homes in the U.S., for example, right?
Yeah.
If no one's wanting to buy anymore, these new homes, or 1 out of 5, like
they'll start
then the
coming
new
down.
Construction starts to slow
and they're not going to start building at all.
Yeah, because then they're going to be taking the loss, right?
Which is going to hurt us.
Yeah.
Which is So like, I don't know. I just look at
it'll anything increase housing a little. That will help increase housing or increase the price of housing.
So it'll balance it out. Yeah, because there'll be less supply.
Yeah. You think builders are going to flip the bill? Because these builders aren't making but so much money on these new builds, and if people are backing out and they have to sell the house for less, who's eating that?
They gotta have like a 20% profit margin though. If they're building it for 160, you would think they're making 200 or collecting 200, don't you think?
So I talked to a lot of builders and they're in the 60 to 80 to 100 range profit per house.
Okay, so then
what do you mean? What do you mean 100% profit?
No, $100,000.
Oh.
So now the house sells for $20,000 less. Now these builders are making $80,000. They might not want to keep doing that because it's a lot of time and a lot of risk to only make 60 or 80 grand on a new build house.
Yeah. Especially if they see a downward trajectotion, they're not going to want to get it.
Because you're borrowing $400,000 to build this house.
Yeah.
And now hoping it sells for $500,000. Or it did sell for $500,000, but then they backed out at the last second.
They're just going to stop building.
They're going to stop building again, and then they stopped building for 5 years, and we were thousands and thousands of
millions.
Yeah, millions of houses short. Now this happens again, we're going to be even more behind.
Yeah.
And then where does it pick back up?
Yeah.
I think interest rates have to go down for
That's when it'll pick back up. That's exactly when it'll pick back up. That's when the whole economy's probably going to get picked
But then
back
the
up.
downside is they do that for 2 or 3 years and then we do the same cycle all over again. It's just a monopoly and they just keep going around and they'll drop it and then it comes back.
Yeah.
And it goes back down.
Again, it's a pendulum.
Yeah, exactly.
It's a pendulum. The extremes. They're definitely extremes, so you just have to find yourself in the middle somewhere.
So if you were a new builder right now, what would you be thinking? Because there's a lot of new builders out there right now that they've only seen the good over the last 3 years. What do you
last
think?
10 years, really, actually.
Yeah, even longer.
I'm sure they're probably thinking the same thing as everyone else is thinking. They're not seeing as much demand for their houses, people backing out.
Mm-hmm. I mean, we saw it. One of our friends recently, they put them brand new new builds on the market, and it took 14 days to sell. Kaylin and them.
Yeah. Longer.
14 days isn't bad. That's not bad though, is it?
No. I think it was a little bit longer than that.
Was it longer than 14?
Yeah. But they sat on the market and I think one of them they ended up
keeping.
No. They sold both of them.
Yeah.
And I guess as much as I could disclose, they did good.
Okay.
Even though it sat for that long.
Yeah.
It wasn't like.
You know, it had to have scared them a little bit though.
I think I think because we're also used to it 48
selling
hours.
in 3 or 4
they're probably
days.
not building right now because of it.
No, I don't think that they had anything else lined up as new construction.
Yeah.
But because of the conversations that we've had since going under contract, I don't see them having.
So they're getting a little scared.
They probably wouldn't.
Okay.
They probably wouldn't mind building.
Going again.
Yeah.
Okay.
They probably wouldn't mind.
So
Which is refreshing, but I don't know. For
refreshing.
me, it was just kind of like, I don't know.
Yeah.
That was tricky. I would have been having heart palp. I would have had a heart.
I would have been anxiety, everything. I mean, I would have been scared to death.
Yeah.
What if it was on the market that long? You're talking about?
If it was on the market that long, and then they got.
Well, I feel like 14. Oh, under ask.
Under ask.
Probably only one offer too. I bet.
I don't know. I don't know.
But I would have been nervous going into it because I know me. I'm not that. I mean, I'm a relatively new investor, and it would scare me out of building a new house.
Yeah.
Too much risk.
Let's see. So a couple more points. Yeah. All right. So, traffic of prospective buyers, while also hitting its lowest level since June 2020, with new buyers.
Hard hit by declines.
Yeah, by declines of housing affordability.
Yeah. Which is basically what we've touched on anyways. I mean,
all these points are very related to each
very
other.
Similar. And then also so home purchase applications are down 15% from last year as record low housing stock, rising prices, and the run-ups in interest rates impact demand. Yeah. So I mean it is getting hit in all ways, right?
Mm-hmm. That goes back to us talking to our mortgage brokers, and they're feeling it.
Yeah, I mean
they're not coming in like they used to.
Yeah, like inventory, we were talking about it the other day. Inventory is starting to go up a little bit. Prices are starting to come down a little bit. They're still up there, but they're starting to come down a little bit for some houses. And now, mind you, the decrease in those prices could be for various reasons, right? Like
I agree.
Something that, like at a used car dealership, if there were no cars available for sale and you needed to buy a Toyota, then you don't care if the 4 tires are all mismatching. You're just gonna buy that Toyota, right? Yeah. And now that you have more inventory, just like now we have more houses for sale, I think that the ones that are gonna sell faster are the ones that have the matching tires.
Agreed.
If you're following my analogy, right?
Yeah.
Like
people are more picky now.
You're a little more picky, and you can be because there's more options.
Yeah. So with that, inventory, pricing, and then the run up in interest. I mean, all of us, right? Money starts getting tight. We're a little bit more particular about how we're going to spend our money, right? Where do we go out to eat? I don't know. I don't have a specific place. You know what? Let's just stay home. Yeah. Opposed to if you had money, you're just let's go to Chipotle.
Oh yeah, who cares?
Let's go to whatever, right?
That's called like the wealth effect. If you feel wealthy, your stocks are going up, houses going up, you tend to go out more, spend more. But if everything starts to fall and people are more pessimistic, everyone pulls back while they're spending, which in turn can cause a self-inflicted recession.
Yeah. All right, so a couple other points that are on this article, and I'll read them quickly. It's called Critical Quote. So we've already seen mortgage applications falling in double digits year over year, and existing home sales are likely to follow suit over the next several months, according to Ruben Gonzalez from Keller Williams. He's a chief economist. Mortgage rates going forward will continue to be responsive. But it will be responsive to changes in expectations from the Fed's policy path, as well as the inflation expectations he predicts.
Yeah.
Cool. And then key background information and why this article even exists and why it was written up is with the Fed Reserve scrambling to aggressively raise interest rates in the bid to combat inflation, implementing another 75 basis points. And by 75 basis points, it's 0.75%.
Yeah.
So it gets a little tricky. It's just like 1 point, right, is 1%.
It's 100 basis points.
Yeah, it's 100 basis points.
Yeah.
So for those that aren't that familiar. So 75 basis, so I'll start from the beginning. With the Federal Reserve scrambling to aggressively raise interest rates in a bid to combat inflation, implementing another 75 basis points increased on Wednesday, so yesterday, for us, the 15th of June, home buying has become notably more expensive. Quote, the current housing market will be cooling off and some housing prices declines are likely, end quote.
Yeah.
Says Moody, the chief economist for Marcus Andy. So all of that's just coming at the heels of inflation is high. They're trying to cool things down. They're trying to figure it out. In my opinion, I think that there's a lot of correction that's happening, just like they were trying to correct during the during Corona and the recession that we were going through there. Now they're trying to go in the other direction. So just like they did in overcorrection to the point we are now, just be very wary that there could be an overcorrection in the other direction, which, without being pessimistic, it could be an opportunity when they realize they've overcorrected and they try to shift it back. I think that when that happens,
time to buy.
Time to buy, right? So be a horse in the stable, ready to rock and roll and ready to race out there. But as of now, just be weary, be careful of an approach. No, absolutely.
Don't let good deals go. I mean, I'm buying good deals. I'm just not taking that chance to buy the deals that I wasn't so sure about. I'm passing up on houses to where before I was buying everything.
Yeah. Any final thoughts on that article?
No, but I do think on that article, not really. But I do think we might hit. This next recession might be stagflation, where inflation's increasing and unemployment's increasing at the same time, which is really bad. Which is like a really bad recession.
You see that being
more
of a real thing now?
Because usually with recessions, it starts inflation goes down because people are spending less. Mm-hmm. But in this case, inflation hasn't gone down. I feel like recessions start and GDP's starting to contract, and I think we got like negative 1.4% in the first quarter, and if that's two consecutive months of GDP decline, then we're technically in a recession.
Yep.
And so I think the numbers come out in July 11th or something of the GDP for Q2, and if that's negative, then we're officially in a recession according to the standard, while inflation is still rampant.
Yeah.
So that would be a stagflation.
And I think that's happening internationally too, though.
Yeah, right. It's not just the U.S.
We're going through it.
We're actually better than probably most countries with that. I think other countries are inflating way higher than us.
Yeah.
Now, in y'all's opinion, how do you think that they could do a better job at, decreasing inflation?
How can the Fed do a better job?
Yeah, do you think raising the basis points is going to make a better difference, or I feel like it's going to hurt it a little bit?
What, with inflation?
I don't think it's necessarily going to hurt inflation, but it's going to hurt everybody just to get a number down instead of actually stimulating the economy.
Well, there's one Fed chairman his name is Paul Volcker, and this was like in the 1970s when inflation was like 12, 13%.
Mm-hmm.
Yeah.
He just went ahead and pushed the Fed's funds rate up to like 20%.
It made the jump.
Yeah, it made a jump from just to combat the inflation. Be like, screw you, screw the economy. We need to fix it. So
not as slow.
Yeah, not slow, and it created a huge contraction in the economy, but it did fix inflation. And I'm not saying that Jerome Powell he doesn't think he's going to do that at all based on his statements. I mean, he's not just going to come out of nowhere and be like, all right, 5% interest rate.
Yeah.
It would stop everybody in their
tracks. Could you imagine? We wake up the next day and we're like,
10 points.
We can't keep none of these and we can't sell them. What would we do? We got 3 projects we're working on.
No, I think private money and hard money would understand
Agreed.
And they would have to renegotiate and figure,
and
hey,
then,
if I get this money, where am I even going to put it?
Well,
right?
at that
So, like,
point,
they would have to just keep the loans.
Well, at that point, savings rates are going to be paying like 8%.
I was going to say, in that instance, I think it'd be better to go with the hard money lender than a long-term lender at that point, because these hard money lenders would be like, absolutely, I'll give it to you at 10%.
No, but they'd up their rates to probably 20, 25.
Probably so.
Yeah, but the ones that are currently sitting down, I
think
they would
right.
have to renegotiate.
Oh, they'd have
I think it would have to turn into some sort of long-term, or there'd be a gap, right? There'd be an opportunity. Somebody with a bunch of money who's just sitting on it would be like, I'm starting a new mortgage company, and we're lending for all these investors.
Yes.
You know, because people that are going to get caught, say that did happen.
Yep.
Sure, we would get caught, but there's a lot of other people who do really good work or really good at what they do. They would also get caught. I don't think that wiping them out would do any good for anybody. I think that that's just an opportunity for somebody who can lend, who can pull together $100 million or whatever and start lending out.
That's when we tap into our network, because you know how many people have 401ks that are just sitting on bonds and stuff like that because they're up in age, 60 years old, and they don't want to take a risk right now. That's when those guys might enter in and be like, "Hey, I got $600,000 in my 401k."
Would they really pull out at that point? Would they pull out because
I don't know.
Their 401k is shot right now.
They definitely shouldn't, but they might get scared. I mean, I know people that pulled out their stocks at the bottom of COVID. I mean, it's all a mentality thing.
Yeah,
agreed.
They could. But to answer your question, the Fed, I feel like the only thing they could do to combat inflation is raise interest rates. But the government, I mean, they could do stuff like drill more to lower gas, because gas is a huge, it's probably the biggest thing that causes inflation, because everything gets shipped back and forth and people use it. Everyone uses gas. So to really combat it, I mean, I think the government's going to have to step in and find a way to lower the price of gas.
So I agree, because if it got lowered, I think it would help a lot of material costs, shipping costs, the whole 9 yards. Everything would go down just a little bit because gas prices were down.
Now, one thing that that is a little frustrating, and maybe I'm just not in tune with the news as much, is I feel like we're not getting anything from the White House. I'm not going to say the president, but I don't think we're getting much from the White House. To ease people's hey guys, we're working on this. We're having conversations. The world is doing this. We're gonna get ahead of it. Let's come together. If there's ever gonna be a thing that we're gonna come together on, is this? Let's come back. But we're not having these conversations. We're not taking the opportunity.
They don't care
To bring it together.
Yeah.
You know.
They're just not saying anything.
So I feel like
I think they're just as scared, probably like, what the hell's going on?
But that's an issue. That's a lack of leadership, right?
No,
and again, not from the president, but from the White House. The government as a whole, right? Leadership, and that's probably because they're so separated, right?
Oh, yeah.
Such bipartisan.
Well, right now the Democrats all own all three of the House, so it's not like they could easily pass a bill or do something, but.
Yeah.
I mean, they own the House, the Senate, and the presidency right now.
I guess they can't print money, so that's probably why they're quiet.
They realize, shit, we can't get out printing money.
We did that for 2 years.
Well,
sorry to go on a tangent.
Yeah, sorry. So that's that. There's a torpedo going to hit the U.S. economy.
Possibly.
All in theory. But so if you guys have any further thoughts, or if you guys have any questions, any good articles that you guys read, and you guys want to send it our way, I mean, we don't mind. We all are on Instagram. Our Instagram and TikTok stuff is all going to be at the bottom. Send us messages privately or as a group. Put it in the comment section. But again, if you haven't subscribe and
like.
Yes.
And share the podcast. If you learned something, if you thought it was valuable for any reason, we don't run ads, so share the podcast. And that way it can get more exposure to everybody, and everyone can learn about real estate and the market and stocks and the recession and everything.
Everybody keep hustling.
And with that, Generation...